So, what are options? Explain its types. Options are financial derivatives that provide the holder with right, but not the obligation to buy or sell an underlying asset at a predetermined price, known as strike price, at a predetermined date. They are used for various purposes, including hedging risk, speculation, and generating income. The key types of options are call option, put option. Call option gives the holder the right to buy the underlying asset at a predetermined price and at a predetermined date, while a put option gives the holder the right to sell the underlying asset at a strike price before or at the expiration date. So, what are the different positions an investor can take in an option? So, the investor can take basically two types of positions: long position or short position, where long position means to buy and short position means to sell. So, what is the difference between American and European option? American and European options are two different types of option contracts that differ mainly in terms of when options can be exercised. In case of American options, uh, uh, American option can be exercised at any time before and including the option expiration date, while it provides greater flexibility to the holder as they can choose the optimal time to exercise based on market conditions. It is typically used for options on individual stocks and commodities. If an investor holds an American call option on a stock, they can choose to exercise the option any time before the expiration date if the stock price exceeds the strike price. While in case of European option, it can only be exercised at the expiration date. It provides less flexibility but simplifies valuation and hedging strategies because the exercise date is fixed. It is often used for options on indices and certain financial derivatives. If an investor holds a European call option on an index, they can only exercise the option on the specified expiration date, regardless of how favorable the price movement might be before that date. What is moneyness of the option? Moneyness is a term that is used to describe the relationship between price of the underlying asset and strike price of an option. It indicates whether exercising the option would be profitable if it were exercised right now. Moneyness helps traders and investors understand the intrinsic value of an option. So, moneyness can be defined in three ways: in the money, at the money, out of the money. An in the money call option is if the price of the underlying asset is greater than strike price in case of call option. And in case of put option, in the money put option means if the price of the asset, underlying asset, is less than the strike price. In case of at the money call and put option, an option is an at the money if the price of the underlying is equal to the strike price. In case of out of the money, a call option is an OTM if price of the underlying is less than strike price, while a put option is OTM if the strike underlying asset, the price of the underlying asset is greater than the strike price. So, what are intrinsic and extrinsic values in options and how these values are determined? So, understanding intrinsic and extrinsic values of an option is crucial for assessing their overall worth and making informed trading decisions. Intrinsic value is the inherent value of an option if it were exercised immediately. It is determined by the difference between the underlying asset's current price and the option strike price. Intrinsic value reflects the profit that would be realized if the option were exercised at the current moment. For call option, the intrinsic value can be calculated as max of zero or strike price minus stock price minus strike price, while the intrinsic value of a put option is calculated as max of zero or strike price minus stock price. In case of extrinsic value is also known as the time value because the time left until the option contract expires is one of the primary factors affecting the extrinsic value. Another factor that affects the extrinsic value is implied volatility. Extrinsic value equals to option premium minus intrinsic value, where option premium is the total price of the option. Understanding the intrinsic and extrinsic values help traders and investors assess the true worth of option and make informed decisions about buying, selling, or holding options based on their market expectation and risk tolerance. What are the advantages and disadvantages of trading in the money options? And the advantages of trading in the money options are it has higher intrinsic value because the strike price is favorable compared to the current price of underlying asset. While it has greater likelihood for profit since ITM options already have intrinsic value, they are more likely to be exercised or sold at profit compared to at the money or OTM options. It has lower risk of expiration worthless because ITM options have less risk of expiring worthless compared to OTM options because the underlying asset price is already in favorable range for the option holder. While the disadvantages are ITM options usually have a higher premium than OTM or ATM options because they have intrinsic value. The higher premium means a larger upfront cost to enter the trade. It has less leverage compared to OTM options, as ITM options provide less leverage as a significant portion of their price is intrinsic value. This means the potential for large percentage gains is reduced compared to OTM options if the underlying asset moves favorably. Also, there is limited upside in volatile markets as ITM options may not benefit as much from increase in volatility compared to OTM options, which are more sensitive to change in implied volatility and time value. What are the advantages and disadvantages of trading at the money options? At the money options typically have a moderate premium combining both intrinsic value, which is close to zero, and extrinsic value, which makes them less expensive than ITM options but more affordable than OTM options. It has higher sensitivity to price movement as ATM options are highly responsive to changes in price of underlying asset. Small movements can significantly affect the options value, offering a good balance between risk and reward. It has the best gamma and theta or option breaks. ATM options benefit from having the highest rate of change of delta or gamma and theta, the time decay values, making them ideal for short-term strategies and capturing quick price movements. While the disadvantages are if the underlying asset price does not move beyond the strike price, the ATM option can expire worthless, meaning the buyer loses the entire premium that has been paid to buy the option. While time decays fast as ATM options approach expiry, the extrinsic value decays rapidly due to time decay, that is theta, leading to a loss of value if underlying asset doesn't move significantly. While ATM options are at a critical point where the underlying asset's price is close to the strike price, adding uncertainty, the position could easily become OTM or ITM with small price movements. What are the advantages and disadvantages of trading OTM options? OTM options generally have a lower premium because they have no intrinsic value. This makes them a cost effective way to take a position with limited initial investment. It has higher leverage potential as OTM options offer the highest leverage. If the underlying asset's price moves significantly in the right direction, the percentage gain can be substantial, offering high rewards relative to the premium trade. OTM options are best for speculation and are favored by speculators due to their low cost and high potential for profit if the underlying asset experiences large price swings. The disadvantages are it has higher risk of expiring worthless as OTM options have no intrinsic value at the time of purchase, meaning they are more likely to expire worthless if the underlying asset's price does not move in the expected direction. While OTM options lose their value quickly as time passes, especially close to expiration. Since their value is entirely based on extrinsic factors, time decay can quickly erode the option's value if the underlying asset doesn't move in favor of option holder. It has lower probability of profit as OTM options have lower probability of reaching the strike price, meaning the chances of realizing a profit are smaller compared to ITM or ATM options. What are the different types of underlying in an options contract? So the different types of underlying assets in an options contract could be stocks, indexes, exchange traded funds, currencies, commodities, interest rates, futures contracts, real estate investment trusts, mutual funds, volatility indexes. What are the different types of orders placed by a trader in a futures market? So the different types of orders placed by a trader in a futures market are market order, limit order, stop order or stop loss order, stop limit order, good till cancelled order, day order. So going I'm going through each one of them. Market order is used to buy or sell a futures contract immediately at the current market price. Traders use market orders when they need to enter or exit a position quickly, regardless of the exact price, ensuring the order is executed immediately. A limit order specifies a price at which trader is willing to buy or sell a futures contract. For buy orders, it is at the limit price or lower. For sell order, it is at limit price or higher. Traders use limit orders to control the execution price, accepting the risk that the order may not be filled if the market does not reach the specified price. Stop loss order. A stop order becomes a market order once the market reaches a specified price known as stop price. Traders use stop order to limit losses or protect profits on an existing position by triggering an order to buy or sell when the market moves unfavorably. Stop limit order. A stop limit order combines features of stop and limit orders. Once the stop price is reached, the order becomes a limit order to buy or sell at a specified price or better. Traders use stop limit orders to gain more control over the execution price after the stop price is triggered, reducing the risk of getting an unfavorable price. Good till cancelled order. A GTC order remains active until it is either executed or manually cancelled by the trader. Trader uses GTC orders when they want to order to stay open across multiple trading sessions until their specified conditions are met. Day order. Day order is only valid for the trading day on which it is placed. If each day is not executed by the end of trading session, it is automatically cancelled. Traders use day orders when they do not want their orders to carry over to the next trading day. So what is put call parity? Put call parity is a fundamental principle in options pricing that defines a specific relationship between the prices of European put and call options with the same strike price and expiration date. This principle helps in understanding how call and put options are interrelated and ensures that there is no arbitrage opportunities in the market. The equation is given by C minus P is equal to S minus K e to the power minus RT, where C is call option price, P is put option price, S is current stock price, K is strike price, R is risk-free interest rate, and T is time to expiration. What are the assumptions under a put call parity principle? The put call parity principle is based on the following key assumptions. The put call parity option applies to European options, which can only be exercised at expiration. The underlying asset does not pay dividends during the life of the options. The market is efficient, meaning that all available information is reflected in the price of securities and options. There are no underlying transaction cost, taxes, or fees for buying or selling options or on the underlying asset. The risk-free interest rate is constant over the life of the options. The market does not allow for arbitrage opportunities, meaning that it is impossible to make a risk-free profit by exploiting price differences. So how would one derive the put-call parity equation? The put-call parity establishes a relationship between prices of European call and European put option and the underlying asset. So first of all, we need to set up two portfolios. Let's call portfolio A, which has a long European call option C, long with a zero coupon bond with a face value of K maturing at time T. The bond's current price would be K e to the power minus RT, where R is the risk-free interest rate and T is the time to expiry, while portfolio B consists of a long European put option and long one share of the underlying asset. So now we need to determine the payoff at expiration, wherein in case of the portfolio A, which is long call option plus a bond. So if stock price is greater than strike price, when the option is exercised, then the payoff would be strike stock price minus strike price plus strike price. That would be strike price, stock price. So, and if the stock price is less than the strike price, when the call option, then the call option is not exercised, then the payoff would be just the strike price. In case of put option, strike price of the bond. In case of put option, portfolio B, that is the put option plus underlying asset. In both the similar cases, that is, if the stock price is greater than strike price. Ah, mhm. Ipda.